Arvind Fashion in the spotlight, and let's connect then with the management to discuss the quarterly performance. It's been a mixed set. Shailesh Chaturvedi is the MD and CEO now joining in. Thanks much for taking time out. Given the fact that consumer discretionary demand has taken a hit, you've also alluded to a challenging demand environment in Q1. How are you seeing the overall outlook for demand shaping up? What kind of top-line growth are you looking at?
See, we've seen a high base last year where post-COVID consumers had really spent money, travel. There were a lot of weddings, and this summer season we saw less number of wedding dates. And industry is feeling that by festival season this time the demand should pick up. So we remain hopeful that the growth will come back to the sector.
Now, after 3 years, we've seen your revenues cross that 4,000 crore mark in FY23. So just wanted to understand from you, what is the target for FY24?
See, we've guided revenue growth of 12 to 15%. And that's based on a couple of growth drivers, like expansion of stores, going to new town, like-to-like growth in our stores, adjacent category expansion and digitalization. And a lot of those growth levers are still active, and we believe that we should be able to grow our revenue as per our guidelines.
Shailesh, what I wanted to understand was margins, right? Because they've improved in the first quarter with the mix shifting towards premiumization, cost rationalization initiatives. How would the margin profile evolve for the full year going forward?
So if you look at our margin last year, we added 300 basis points in the last financial year. In this quarter, our EBITDA again gone up further by another 190 basis point, and we've grown our EBITDA by 24%. And we are hopeful that this, propensity to grow profitability, the efforts will yield. And our guidance again on the EBITDA margins is that between 100 basis point to 150 basis point growth in EBITDA will happen, and regularly with our cost control measures and lower discounting, we should be able to grow EBITDA by another 100 basis point. And if the times are good and if the festival demand picks up as the industry believes, we should be able to grow maybe towards 150 basis point as well.
But what the street and your investors would like to know is that despite all these measures in place, improvement in margins, cost rationalization, etc., you've still posted a loss. What's hurting profitability then?
In this quarter, we had a increasing taxes. So this year, our tax in the quarter was 19 crores versus last year, same quarter was 5 crores. So there was a higher tax in this quarter, including a one-off tax of 7.2 crores. Our PVH part of the business had declared 100 crore dividend in the quarter one, and 50 crore of that came into Arvind Fashion. And for that dividend income, we had to make a provision of this 7.2 crore tax. It's a one-off thing. And the remaining increase in the tax is coming from the PVH part of the business. So we've seen a little larger tax increase in this quarter than normal. And like I said, 7.2 crore is a one-off tax increase, and that's taken down the PAT little more.
Okay, fair enough. Now, out of the 4% growth that you've posted, how much can be attributed to volume and how much to pricing? And what's your sense on growth shaping up this year? Will it be largely led by volumes or better pricing?
So, we have premiumized our product line, our brand. So the net realization by selling a little more premium products, we are seeing a higher realization on prices in our portfolio. And in the current muted condition, volume growth has remained a little muted. So the growth is coming right now for better products and premiumization efforts currently.
Okay, and what about the growth from the emerging brand portfolio? That has outpaced your power brand. So help us understand how the emerging brands have really posted this kind of growth despite a fairly challenging demand environment.
I think that entirely can be attributed to the good performance of Calvin Klein. Calvin Klein has grown like-to-like even in this condition by double digit. And on top of that, the overall growth is even higher. And even the margin profile of Calvin Klein has really improved because they're one of the leading brand with the highest full price sell through. So the most of the gain that you see in emerging brand portfolio is coming from very good performance of Calvin Klein. Also, I must add here is that we are also benefiting by cleanup of our portfolio. So we have you may be aware that we cleaned up a lot of our emerging brands, and in this quarter we don't have those losses which we had seen in the previous quarter last year. So both cleaning up of our portfolio, cutting down of the tail brand, and very good performance of Calvin Klein is leading to very good performance of G emerging brand portfolio.
Shailen, you had earlier said that most of your brands will be about 1,000 crore rupees in 2 years. Are you on track with that? And which brands would you actually see crossing this milestone?
I think we are working on that, strategy that we want fewer but largish brands, and there's a large, link of scale with profitability. The leverage comes in, so we are onto that strategy, and we are making good progress. Last year, for example, we grew at 45%, and all our brands grew much larger in scale than we had budgeted. So that path is on. This quarter also, a couple of our channel, like for example, retail and department stores, even in these conditions, have grown at more than 15%, and those channels will continue to drive the overall growth of our brands. And all these, 5 apparel brands from US Polo, which is now close to 2,000 crore business, Tommy CK portfolio, which crossed 1,000 crore together last year and growing very, very rapidly, Arrow and Flying Machine, which are close to 500 plus, and they will take a couple of years to reach 1,000 crore. But that strategy of making the brand bigger and hence more profitable is on, and we believe in that strategy, and we're putting a lot of efforts to achieve that strategy.
All right. And can you just walk us through the outlook in terms of, what your debt reduction target is? Because you do have expansion plans, you've got marketing spends, other initiatives that you spoke about. So what is your debt reduction plan?
We are very, very tight on balance sheet. And if you see last 2 years, we've grown our top line last year, for example, with 45% and 2,500 crore top line with hardly any increase in debt. So we are very, very tight, and we are increasing the stock turns. This quarter also, we have achieved stock turns of 4. So our focus is on achieving growth with minimal increase in inventory or debt. So our debt levels have remained steady at 600 odd crores gross debt. And we believe that in the second half of the year, when typically the cash gets generated from the business, because the festival efforts, we tend to build in the inventory and then we realize the cash. So in the second half of the second half of the year, we'll see some more cash getting generated from the business. So we remain optimistic that our debt levels will remain stable.
Okay, and what is the plan to guide to add further stores? You had guided for 200 this year. What are the geographies and which are the brands?
We are very keen, and we are on track for our 200 plus store expansion. This quarter 1, we added 45 stores, and these 200 stores are across these 5 brands that I mentioned, and all these brands are growing their number, and we will grow, and we see a portion in the big city, the suburb of the big city, which are becoming very, very important, as well as small tier 2 and 3 towns. So it's not like a one cluster approach, but we are seeing opportunity to grow the stores of our brand across the country.
Right. Okay. Great to then have you today on the show, Shailesh. Thanks for so candidly speaking with us and, of course, giving us a color on what lies ahead for Arvind Fashion.
Thanks.
Let's bring up that stock price up for you and show you where it's currently in trade, a little bit soft as we speak. But a lot of other